Welcome, everyone. Welcome to 1 Million Minds. I think it's episode 6. We want to continue our conversation we had with Raghu about investment versus trading. We had a few more interesting topics to cover in that. And then we have another topic that Balaji is going to walk us through is the evolving Web3 landscape. Things are changing on a daily basis. So what are some of the infrastructure things that are evolving so we could all get used to where things are going. I was talking to these guys before we started. I was interested in AI space and kind of fizzled out, but the AI space now has amazing use cases, but it's happened over the last 10 to 12 years. So what I envision is that's how blockchain Web3 is going to go to. We will see some use cases play out in the next 3 to 5 years, but I think in 10 plus years, this will become the norm, right? Like just like how AI is basically taken over, like feels like it came out of nowhere, but it's been the developers and the builders have been doing this for a while, for 10 years to really get to where we are. So that I think that's where the Web3 evolution will be helpful, kind of overlaying with everything else that happened in Web2, and how do we, what are some of the things we can see and trends we can jump on. So, Senda, how are you guys doing? Balaji, Raghu?
Yeah, excellent. Yeah. So I think this week I spent good part of time playing with some AI software. It was fun, right? Especially Stable Diffusion, the face hugging kind of software, how you can morph people from one video to another. I was very surprised. There's this new software called EBSynth, which basically takes one keyframe. You just provide an artist rendering, and then you put you can act for it, and then it'll blend it and create that character that the artist put in there. So you don't need to draw every single, like a cartoonist anymore, right? You just draw a few keyframes and you can actually create a video out of the whole thing. So it's fun stuff.
It is. I mean, the use cases are like limitless, right? Like, for example, I was just thinking about it, like when we want to read a story to our kids, that can be all already made into a video. The kids can give a few prompts to create their own stories. So you can go to the extreme. I was listening to somebody about this. You can go to an extreme where, imagine in Netflix browsing, you create your own video. You just give some prompts and it'll create a story for you based on your viewing history. So where I see this going in the next few years it's just crazy. Yes, and then imagine being able to create a whole Avatar movie. I think the Avatar movie was multiple millions, right? You can create something in $100,000 or even lesser. That level of complexity is going to come through. So I'm just excited where this is going. And what you said, I found another one called Midjourney, Balaji. I've just been playing around with it. I'm doing a very simple use case for thumbnails, but there's so much that you can dig into. It's really exciting.
GPT is also good. GPT-3, GPT-4, you can put some random texts and it'll create a story for you.
Right.
Basically it keeps feeding it. Yes, it's brilliant. I played around with it a few months ago, and it's like, because I like to write, and I put some random sentence in it, and then it creates a new sentence. Then it's like goes on like a sequence, and then at the end of the day you become an author without knowing much about writing. See what I mean? Like, this is going to completely change the landscape of writing, I think.
It is a lot of, yeah.
Yeah, I can talk all day long, but writing is like my Achilles heel. But also what I like is a little bit of humor in writing, right? So I want to see how AI reacts to it. So humor is so much context is one of the toughest. It sounds easy. Like comedians are one of the smartest people because you have to kind of overlay your joke with the context, and it has to reach the right audience. Can AI get there? If it's there, then we're in trouble, but it'll make my writing easier. So I want to instill some humor into some of the business things we're talking about, but I'm looking forward to it. So how's the weather in London, Raghu?
It's getting colder now. It's getting, the usual fall, as you call it. The autumn is slightly getting, winter's coming in, and yeah, we hate this weather. I just want to get out and have some. Yeah, I was happy.
That's why we are in California, Texas. we have 2 weeks of winter in Texas, so that's about it.
Oh man,
and then
Texas is a beautiful place. I passed through it a few times.
Yeah, he's carefully not talking about the summertime. It's like you sweat in the shower.
Yeah. You just have to take 4 showers, otherwise it's okay.
Exactly.
All right, guys. So let's get started. Maybe Balaji, if you can bring up the slides. Let's Raghu. Let's kind of pick up where we left off last week, and then I think let's have a conversation about it, and then we'll jump into our Web3 evolution study.
Yeah, so just continuing with where we left last week, we talked about trading was investing, and then we started talking about derivatives as such, right? Which Mr. Warren Buffett calls us the weapon of mass destruction. But having said that, I think derivative trading is quite rewarding, and it's fun and quite challenging. So we briefly touched upon futures as one of the. So there are primarily two kinds of derivatives: is options and futures for the for the vanilla market that you and I can trade. So we saw that the futures are different from stock in the sense that futures have shelf life, if you may. Basically, futures come and go, and then obviously you need to roll over your positions in the future. And so on and so forth. So that is one, and also futures are leveraged instruments, and that brings us to the point of the danger element of futures, the danger element of trading. I mean, I'm sure you guys would know what leverage is. I mean, even the respected audience out there, but to bring a brevity to it, so leverage means you don't have to, unlike stocks where you have to put the whole money out up front. Say if let's say I don't know, Apple is trading, whatever, X dollars. You have to put the whole X dollars to buy an Apple stock upfront, right? But that's not the case with futures and options, where you have this concept of leverage which kicks in. Basically, it means that like if it costs X dollar for futures for the market, you don't have to put all the X dollars. You can put one tenth of it. So basically that's the leverage. So you don't have to have the whole money in your pocket. So that's also called as a margin. So you got the what they call as the margining process, where the initial amount that you put in is called as the initial margin, and as the market goes up and down on a daily basis, depending on whether you're long or short, the variation margin will kick in. So either the broker will call you for a margin call. I mean, not physically call you, but obviously they'll debit your account with X number of dollars, and if the other way around, then your account will get credited to the appropriate amount of money that you have gained on a mark-to-market basis. So that's the whole idea of leverage. But while leverage sounds quite enticing, it is also a double-edged sword in the sense that it's like a Damocles sword which is hanging on your top all the time, because a silly mistake, like say for instance, if you are basically like what we said earlier, say if you bought if let's say if there's something that is trading $100 and you don't want to put in $100, say you put $10 up front, which means you're 10x leveraged, right? So if the market goes up by 1%, right, you gain 10%. Obviously, your profit is enhanced by 10%, even though the market has actually gone by 1%. So that sounds like too good to be true. It is true, but there is a catch, which is the flip side is the market goes down by 1%, you end up losing 10%, right? So that's the whole idea of the leverage. So one has to be really careful about the leverage and trading the leverage. So I typically keep things tight and have stop losses in trading futures. It is a dangerous asset to trade. I mean, as a class to trade or whatever, but it is also fun to trade. So yeah.
Correct. I think to your point, right? Leverage is the reason a lot of these collapses have happened with the FTX and others who've misused leverage. So again, none of what we say is financial advice, but at the end of the day, there's just another tool. If your hypothesis on the direction of the market is right, then you have a unsymmetrical upside, right? Basically, it won't be a 1:1. It could be a 1:10. To the other point, it could be a 1:10 downside too. So this is definitely a more advanced topic for most people. So tread carefully. But if you have a very firm conviction, then it's a great tool to leverage, basically.
Yeah.
Where does the time component come into play, right? I mean, looking at this, is the futures, does it include the time component, or is it just the leverage?
Future doesn't include time. Future includes the time in the sense that it obviously expires, but it's a good question, because options, which we haven't touched upon, which is a slightly more complicated topic, they have the time component, which means not only they go off the window, but they also decay over time. So they have a certain exponential rate of decaying. So if you bought an option which you paid, say a put or a call, and you keep it in your in your position, and the market doesn't move, and but slowly and steadily you'll start losing more and more money, and by the time the option expires, you eventually lose out all your the money that you put in initially. So that's the time component which comes into play in terms of the option, but futures, it doesn't. Yeah.
So the other question I have. Oh, go ahead, Rajni.
Go ahead.
Yeah.
And I was trying to kind of bring it home because like a lot of airline companies hedge their oil, basically the oil, right? Like Southwest did like if they predict that the price of oil is going to go higher in the future, then they try to hedge, whether it's buying futures or options, whichever way they do it. That way they can, that's one of the biggest expense of an airline industry. So if they can bring some control over it, then they have better ways of actually earning a profit in the future, right? So there's the big companies who do this just to help them smoothen out some of these volatility too. So it's just not individual traders who do it. A lot of big companies, I mean, Southwest is just one example.
Yeah, all industries that are exposed to the market in some form or fashion, they all hedge, be it futures or with options. Like the big grain producers in the US in the Midwest, if you look at it, like, they all go out and they hedge, because obviously they are long the physical commodity, which they grow the let's say they grow wheat, but obviously the price of the wheat keeps on yo-yoing, if you will, right, on a daily basis. So they want to make sure that their produce or their yield gives them enough profits to run it on a sustainable basis as a business. So hedging is a very integral component of, especially hedging with derivatives, is an integral component of any business that is in the somewhat involved in the market side. Be it steel, iron, grains, or oil, as Rajni was saying. So yeah, that's the interesting bit of.
So I have one other question related to leverage. I know I've been hearing this in comparison with the traditional markets and the crypto markets, right? So first thing, I mean, I hear this: what's a good yield? Like, is it too much and don't touch it because there's something shady going on, because somebody's giving you 20% yield versus traditional market is not giving that? The same question with the leverage. Like, what's a good leverage, right? Is it 10x, 100x, 1000x? What is this leverage? Can you do this kind of stuff?
No, it's a good question, but in the traditional, as far as crypto is concerned, right, because it has been a wild west so far, at least, right, until the the police or the regulators are going to come in. Most of the exchanges have been having a free, like a free play, or what do you call it, the power play, so to speak, in the cricket parlance, right? So they've been recklessly giving out, and people, people like a lot of people don't know much of trading. They get attracted to high leverages, like as I said, 100x and 1000x, and then it's like a Venus flytrap, and then they go like an insect, and then they fall into the trap, and they eventually wither away. So it's extremely dangerous. I mean, as far as traditional markets are concerned, I think anywhere between 4x to 8x is typically a good leverage. But even interestingly, what you can also do is, I mean, instead of thinking from a leverage perspective, it's easier to think of if you restrict your stop losses, say to 2.5 to 3% per trade, whatever trades you are doing, right? That is 3% of your kitty, the capital that you have for trading, unleveraged capital, I'm saying. Then it sort of makes sense to think in that angle rather than only thinking from a leverage. But even if you think from leverage angle, 4x to 8x is, I would say, a reasonable leverage.
So here's the next question. Again, as you talk, my brain is going off. Like, okay, now you said stop losses with crypto. Everything is public. Like, what if like somebody looks at all the orders and now they say, oh, this. I think some conversations I hear. Maybe I'm ignorant of this, but I hear, okay, 13,500 is the liquidation level of this company. If you go at it, you can liquidate them, right? Because they bought it at this rate and they hold it and probably they put in some orders. And so does it expose the stop order itself? Does it expose a risk to the investment community in the crypto? Because now, what if you are trading
that's a good question.
right? Like people know where to liquidate.
Absolutely. No, good question. So like two things here. An order doesn't, that an order is a stop order, a limit order, a market order. The market doesn't know, obviously. It doesn't go along with the a tag saying that this is stop. It's a stop order from your side as a trader or as an investor, but the market doesn't know. Having said that, what people are saying is, things like, at least in the traditional markets that I've been with, by the large banks that we used to trade, institutions, as Rajni was saying, used to buy large hedges, right? And they would buy things like calls and puts. And sometimes what they do is they when the market expires, the bankers that we sold these options, right? So we know that at a particular point, the strike price at which we sold them or bought those calls and puts, those are called the magnet strikes or the pivot points, as you call them. And typically, some industry insiders would know that these are the points at which the bankers would defend their positions, if you may.
Right.
But if you're a large bank, if you've got deep pockets, it's easy to defend, but it's not that easy as well. But the good thing about we can talk about it maybe in the ensuing slides or maybe the next few conversations. But an interesting thing that to look at is if you look at the open interest of a particular option or a future, then you would know that on a particular option, rather on a particular strike, you would know that this strike has the maximum open interest, and that would be the magnet strike. So when the market comes to expiry, people either side of those strikes would try to defend them. So it depends on who's got the bigger pocket, and so obviously, So that's a good question. But typically speaking, in a large market like BTC, it's very difficult to say where is the pivot. You don't know. But as I said, technical charts, if you look at things like Fibonacci series, right? The Fibonacci retracements, as they call it, is a very simple thing that you just draw two lines, and then you see, and between these two lines, you got the 50% retracement, 37% retracement. The Fibo numbers. Those numbers are generally considered to be sacrosanct, and people defend those. People come in, get out, and those are support and resistance lines. This is across all people. I'm not talking about even savvy bankers. I mean, bankers also believe in all these technical charts and also. So that's how they trade.
Interesting. Okay, cool.
Yeah. Sorry, just go on the last point I forgot to mention. But anyway, so futures trading is just like stock trading. Okay. I've just put in so as far as I know, Binance, CME, and Deribit are some of the well-known and large exchanges for trading BTC and ETH futures and options. And CME is obviously very preferable to people who have lots very deep pockets. As I was saying the other day, it's to trade one lot of Bitcoin. I think you need to put in 10 to 15 grand on CME. So it's an expensive proposition. That's probably one of the reasons where people move on to Deribit and Binance. And I like Deribit because it's I think registered within the US, therefore follow the laws, and they also are insured by the I don't know the technical term for the American the
bank, FDIC.
FDIC, the deposit company, right? Yeah. So there is a certain amount of checks and balances around Deribit, which I find to be very interesting. Binance, as I said, is a lot more Wild West in the sense that they keep introducing very interesting products. Lots of products. It's quite confounding if you're an initial trader, and if you go in there, they got probably 50 to 80 products alone, and you can do many things there. But sticking just to a couple of simple ideas like futures trading, it might benefit some initial, beginner traders. CME, as I said, is very well known. It's the oldest exchange in the world. I mean, obviously CME started off as CBOT. If you look at the history of exchanges, it was called to be Chicago Board of Trade. It used to be known as, and then it became Chicago Mercantile Exchange, and then the rest is history. So it's like one of the oldest exchanges, and solid balance sheet they have. So yeah, if somebody is very keen and they want to trade CSE, it's best. The safest bet would be CME, and then next would be Deribit, and then probably the third in terms of the hierarchy of risk that you're taking would be Binance.
Gotcha.
And Binance offers, as you said, a lot of leverage, 1000x also. I think they offer anywhere between 100 to 1000x.
That's where I had this question, like because I keep reading some articles about the multiples of leverage they offer, and it's like, what's that?
Yeah, I mean, like that's the problem, right? I mean, if you're trading 1000x, it's almost it's like driving a Ferrari at 350 miles an hour blindfolded. I mean, to be honest with you, if you do, yeah, that's the problem. The 1000x leverage. So yeah, that's absolutely no.
Gotcha.
Yeah. So yeah, cool. Let's move on to the next, please. Yeah. So this I just put in, like, for people to the simplicity sake. This is futures trading payoff. Like, is exactly similar to stock, right? If you bought the stock $100. The stock goes to 120, you make $20. If it goes down to $70, you lose $30. And then if you connect all these numbers, it comes out to be a straight linear line, right? It's not curvilinear like an option trade. So a future is exactly like an option. A future is exactly like a stock. So it's very easy to understand. The only difference, the two main differences: futures have leverage built in them, and then futures have shelf life. That's pretty much it. So in this case, if you look at if you're long futures, basically long means somebody bought the futures, the underlying futures, say Bitcoin futures or Ethereum futures. And if the market goes up, they obviously make money, as you can see on the green line, which is upward sloping. And if the market goes down, they lose money, as it's showing the red line. So the other side of the coin is, obviously, you can also go short futures. Short futures is basically going short. It's just a terminology. Unlike in stock trading, where you borrow and then go short and all sort of things, here, if you have a margin, you just go long or short, doesn't matter. So they are identical in terms of the process, in terms of thinking and perspective. So short futures is if you believe that the market's going to go down, like Bitcoin, like trading at 16,000 at the moment. If you think it has potential to drop another 6K in the next month, then you probably go short a 1 month future from today. So you see, if there's a 1 month future, you go and short it. So say the 1 month future might be up $16,000 or $17,000. You short it, and when it comes to, let's say, 14,000, let's say, if you want to book your profit, so you made your $2,000, and then you reverse the position. So you went short initially, which means you sold the futures, and it went in your favor. It went to 14,000. You made $2,000 on your profits, and then you buy back, and then you net off, you square. So you made your $2,000, and it's as simple as that. Yeah.
So here I have a question regarding. This is all derivatives, and there's underlying asset. How connected are these, right? So let's say I buy futures on, let's say, Bitcoin or whatever, and I pay partial price. Is there anyone holding that actual Bitcoin that is related to that future? So just in case. Where I'm getting confused is that what is the relationship between the amount of futures and the amount of actual asset, right? Can the future amount be 10 million and the actual asset is only 1 million? Is there any correlation there?
Yeah. It's a brilliant question. Like in the traditional markets, for example, commodity markets, what you say holds true always. We call it as tender parity. It's fungible in the sense that if you're long, let's say, futures of gold, and then the market went up, and for commodity markets, many of them on CME are still, it can be asset settled. What I mean, unlike we'll talk about, it's a excellent question. So if you're long gold, for instance, gold futures, and instead of, obviously when you're long gold, the long futures gold, there's somebody else who's short futures gold. There's got to be a netting. Somebody, you bought it, somebody has to sell it there. So let's say if you made enough money in it, but you believe for whatever reason that that you want actually the gold and not the money. You don't want the dollars. So you can actually take delivery of the commodity. So the exchange makes sure that there is enough inventory out there as far as commodities are concerned. But here, in crypto world that we're talking about, in Binance or CME or whatever, all of them are cash settled. There is no the correlation comes from the spot. I mean, we'll talk about correlation. It gets a little bit
so
complicated,
basically
maybe,
you're saying I cannot take Bitcoin delivery. I only get US dollars delivery.
Yeah.
Interesting.
You can just take the US dollar and then buy the Bitcoin, like wherever you can buy a spot. But
very interesting.
That's how. Yeah.
So that means there is no connection. You can sell billions.
No, there is a connection, right? There is a connection because if you, let's say if you're trading Deribit, right? Deribit has a spot market and a futures market. So where you can actually buy the underlying Bitcoin, right, for 16 grand. And at the same time, you can also trade around with the futures. So this is called as a convergence, where why do futures have a time period? Why do they expire at certain time? That's convergence, where what is the futures price actually? The futures price simply tells you that what would be the price of this spot at a future date. As simple as that, if you think about it, right? There's nothing else. So the main connector is the cost of money, in this case, at least in the case of Bitcoin. So if you had 16 grand in your hand today, that's the opportunity cost. So if you take all the $16,000 and you're going to plunge it in buying one Bitcoin, so that's one thing you're doing. So you're essentially, what you're doing is you're foregoing the interest, let's say the risk-free interest rate that you would get if you had put the 16,000 in a bank account, in a safe account,
right,
or in a T-bill or whatever, right? So therein lies the connection, right? So therefore, there is an obvious connection between the futures price and the spot price of Bitcoin. It's called convergence, right? But what I'm saying is, in traditional commodity markets, you can take delivery of physical commodities. It makes sense. But in the case of Bitcoin, which is anyway a ledger number, right? It's a hexadecimal print, if you may. So you can. I mean, obviously, yeah.
Yeah, I mean, the reason why I ask is, especially with Bitcoin, which is touted to be a scarce resource, it can never be minted more. It's going to become scarce. It's going to become scarce more and more, right? So then the question becomes: do you take custody of it and hold it, right? So, or do anyone do that, or with the futures, like, or it doesn't make any sense?
No, it makes sense. It's a good. See, I don't know if you heard of this cash and carry trade. It's been they have been very popular in the last few years. What it means is basically, let's say if you are holding Bitcoin, if you're a hodler, what you do is you put the Bitcoin as a collateral and sell the futures in the same exchange. Okay, let's say you bought Bitcoin at 16,000, right? Let's say the 1 month futures is trading at 16,500. For whatever reason, it could be less than that or more than that. Obviously, let's say, so this works well when the futures market are normal. What it means is they have an upward sloping curve. If you look at the futures market, right, the price of the futures, each of the futures number at a certain date, they follow a traditional, I always get confused between convex and concave, but a curvilinear, shape. So what it means is, like, if, let's say, for instance, if you bought your Bitcoin at $16,000 and the futures is trading at 16,500, 1 month futures. So what you can do, you can put this 16,000 as collateral and sell 1 month futures. Essentially, what it means is you are telling the exchange that, I got this for 16. He doesn't know. You put in this. You put in one lot of Bitcoin. You say, I'm going to sell one lot of Bitcoin in the future in 1 month from now at 16,500. If you think about it, it's a clean $500 profit, risk free.
If it doesn't go to 16,500, right? If it goes to 16,500, right?
No, but you sold it at 16,500. It doesn't matter.
If it goes to 17, you have a problem.
No, it's still okay. You still made 1,500. You still made your $500 in a monthly.
Correct. But what I'm saying is, the people buying at 65 are hoping it goes past that point, right?
If it goes to 17, there is an opportunity loss of $500.
Right.
But you still made your $500 profit.
Got it.
Right. So that's how the cash and carry trade used to be, and it used to be very popular with a lot of investors. I know people who had like $50 million, $100 million of Bitcoin worth. I know some young kids. I talked to them out of Dubai, and these guys, they didn't know what to do. These are like some rich Marwadi kids, and they were long since it was like $100, and this is what they used to do, and they would make about easily 50%, 60% year. Or if you pull the data from the back on Deribit or Binance, you would see that this cash and carry trade used to be like the the gold trade for everybody. People who just buy Bitcoin, put it as collateral, and sell the futures. And it's simple money, right? There is no risk involved. If the market goes up to wherever the market goes, doesn't matter. That's what the hedging is concept, right? Wherever the market goes,
right?
Even if the Bitcoin, even if the price of the Bitcoin tanked, let's say to $12,000, you bought at $16,000. Theoretically, you lost 4,000, but your futures you sold at 16,500 anyway. So the counterparty is bound to buy it from you at $16,500. That's what the exchange takes care of. Yeah, that's what the exchange takes care of. The counterparty risk is negated there. So that's the whole idea about hedging, right? So that's a cash and carry trade, which unfortunately, because everybody started jumping into it, every Tom, Dick, and Harry was doing that. That particular. It was such a simple trade, right? No-brainer trade. The arbitrage went down so much, so small that there's nothing else to play at the moment. I mean, at the moment, anyway, we're looking at backwardation, right? People are looking at markets tanking from here. So I think right now, obviously, that's not a good trade to get in. I mean, there's no trade there, but think about it, like it's easy.
Interesting. Got it.
Perfect.
Okay.
What do we have next?
Yeah, I mean, this is the last slide. I think I just put this derivatives just to show the audience that this is how the derivatives UI looks like, and I just clicked on the futures tab on the top, and you would see these drop downs. If you see 1, 2, 3, 4, 5, 6 expiries. I mean, I can't see. It's November, December. Can't see with my. Let me just grab my. Let me just. Yeah, I'm zooming it in. So November, you have 18th November, 25th November, 30th December. Sorry, 31st March, 30th June 23, and 29th September 23. All of these are different expiries of futures. All of these are contracts. You can go long or short of any of these. So that's this is at least as far as derivative is concerned. And I think Binance even gives you even further down in the rate. Like obviously these are being crypto assets. We have probably up to a year, maybe a year or two. If you look at oil, for instance, which Rajni was saying, they would have like a 10-year futures, 15-year futures. Those are much more deeper markets, liquid markets. But yeah, but this is reasonably deep, liquid enough. The derivative futures are. So I just grabbed the screen for people.
Looking 1 year into it. Okay, interesting.
Yeah, exactly. So if you look at this was on the one that the last expiry is on the 29th of September, and that's the futures price at that point in time was down 5.689%, and that was 16,622. So if you look at these numbers, they're pretty much the same, right? So you can see that these all these
market sentiment. What I mean is this basically saying a year from now, most people are betting BTC is going to be about here or 5% lesser than here, right?
Exactly. Kind of. That's true. I mean, people just trade these spreads. I mean, what you can also do, I mean, probably we can talk about very briefly that you can trade spreads, which are beautiful, like in the sense that you can buy, let's say in this case, we have let's say the 25th November future, and then you can sell a 31st March future or vice versa. So you don't have to restrict yourself by just saying, look, I'm going to buy one or sell one. People trade spreads, and spreads are easy to trade and also less risky because they're not absolute price. If you look at it, they are the difference in prices. So if you look at the volatility of any random variable, right? A simple random variable is more gyrating, if you will, than let's say the difference between two random variables, which are linked to each other. I mean, these are again anyway they're linked. I mean, we're not talking about taking Apple and Microsoft. We're talking about taking Bitcoins or one month expiries versus the Bitcoins other month expiry, and then subtracting them and trading them as an instrument. That also people do. Yeah, but that's a little bit more advanced in terms of quantitative speaking. People look at pairs trading. They look at things like co-integration and statistics and all that sort of. But
I think one of the things that made sense, I think it was Chamath who was talking about in the All In podcast, is this is about a year ago, right? So everybody's worried about where the market is going, but he said, hey, if you have a strong inclination, for example, at that point, he was projecting like between the FANG stocks, Apple and let's say Amazon. But if you really just look at more software related would be Apple and Google, right? So or even Google. So if you take Google on one side and you just bet against like a Facebook that spread, regardless which direction the market goes, one of them is going to be a winner, another one is not going to do so well. And that's, I know it's not future trading, but very similar concept. That's how I understood is if you don't even have to play in two separate markets. Okay, I'm going to play with the oil and then technology. Within the technology space, you can find some pairs to trade where you're betting one's going to do better than the other. And if that played out, at that point we've dropped 70% in Facebook and maybe 15 or 20% in Google, you still come out
Yeah.
better.
Yeah, that's what you do. I mean, irrespective of what you have, whether it is futures or stocks, at the end of the day, what you do is, this is, if you look at the difference between, if you do a differencing of these two numbers, they're just variable at the end of the day, right? And if, especially what Rajni was saying was, if you have a same sector, let's say if you've got a tech sector, when you've got like, say, an Apple and Amazon, and if you
so you just play
them,
the competitors, is that what it is? That's the link, right?
No, you're just playing the correlation basically. What you try to do is, Apple and Amazon, they are in the same industry, or let's say Apple and Microsoft, they're same industry, right? And from many macro perspective, look at, if you pull the numbers and run a simple correlation, they probably be like correlate 70-80%, at least I think. So then they are reasonably, they're a good candidate to trade. So you take these two stocks, you go long in one, go short in one. But the way you do it is, if you pull up a chart and see you simply plot a difference. If you plot the difference, you would see that they are mean reverting in nature. The difference is not, it doesn't go like a, so that's what I was saying. The difference of two variables is, unlike a single variable, is not going to be having huge trends. It's going to be sideways always. And that's called mean reverting in nature, because they would have a certain an average, a mean, and then they would have a certain standard deviation. Obviously, when the correlation breaks, look, the correlation can always break for whatever reasons, right? Say there's something happens, like Sundar Pichai leaves. I mean, I'm not saying he's going to leave, but I shouldn't be saying these things. But yeah, I'm just saying, let's say if Sundar Pichai says, okay, I made enough money, and then I want to be going on a spiritual adventure, so I'm going to let my lieutenants take care of the company. Maybe that could sort of gyrate the Google stock a little bit, I mean, for a brief period, and then the correlation could break between Google and, say, Microsoft, right? Those are things that we can't predict. It's well, you can, I mean, obviously, but it comes, it's not really, it's more like NLP, and you can, Twitter feeds and all that sort of thing. But if you're looking at simple mathematics, right, you just take the gyration, see which is, one is up, one is down, and if they are in the extrema or extremum, if you may, and then you go long one, short one, and wait for time for them to bring it back in your favor. And as Rajni was saying, even if the market goes down or up, you're reasonably.
So that's a interesting. I learned something. So now if I look back, so there's always this debate about traditional markets and Bitcoin, and they're correlated or whatever, the crypto and this. So from what you're saying, is that why this is happening? Because now people are taking the traditional market and somehow the money correlated the crypto into it. So now it's kind of in some kind of a synchronous move, right? Is that what is happening in the market? Like what was previously a random variable or single random variable now got attached to another market. Now they both are gyrating in some pattern, so they can't detach themselves unless FTX happens. I'm just kidding. So
I think the money supply was, so really the way I at least understood it, right? I'm not an expert here, but when the risk-free money basically became 0%, right? If you put in savings. So for anybody who's an investor, you don't want to leave it there. You would at least do inflation. So, and then there was money that you had to take a risk to make money, right? When it comes down to that kind of places, when the crypto market was booming for the last few years and stock market was going nuts. But now everything is down, because right now Vanguard sent me an email saying, hey, you're one of the beta customers who can just make 3.5% in savings. If Vanguard was giving me 3.5% in savings, I would have never put $10,000 in Voyager to make USDC 8%. I wouldn't have done it. When it was 0%, I was tempted to do it. Now I'm taking the money and saving, all put on Vanguard, right? So that explains more of the correlation between stock market and crypto, at least for the last few years, than anything else.
But that's retail. But is that the trader mind works differently, right? The traders are like, okay, I can take the money here, put it there, and circulate it back, and do the loop dance, right? Just continuously flush the whole thing?
I don't think so. I mean, I don't think people look. I mean, as far as I know, at least from an institutional perspective, if people are trading Bitcoin pairs trading, I mean, they would trade BTC ETH. I mean, I'm giving away some interesting thing that we could do here. A simple BTC, because if you look at ETH correlation with BTC, it's almost 85 and above the correlation. So it's a brilliant pair. It's a wonderful candidate, these two candidates to trade, because then you're essentially avoiding. But obviously, you need to you got to dollar weight them properly, because one is trading at like $2,000, the other is at 60 grand. So you need to make sure that your net exposure, long and short, are dollar equivalent. But I don't know. I mean, to be honest with you, I don't think so that people are
right. This is the biggest mystery, right? The BTC and ETH are completely different animals. How are they even correlated? That's the big question I have, right? How are they even correlated? Yes, it is correlated according to whatever numbers we see, but there is no technical reason behind the technology for them. One is like a propagated store of value, payment mechanism, or a currency, and the other is a internet computer. How are these even related?
I think it's perception and expectation. Perception and expectation. I think perception, because people perceive BTC to be the bellwether, the what do you call it, the lead of the whole blockchain, if you may, right? So therefore, everybody believes in Bitcoin for whatever reason. The story has been sold very well. Ecuador, was it Ecuador or Costa Rica? Whatever, the guys have gone all in there. Even though they had 2 and 3 on their hands, on the poker hands, they went all in with their monies. But yeah, I mean, you're right. I mean, look, you're absolutely right in the sense that one is fueling DeFi, which is quite useful from a value perspective, right? ETH is being quite useful as an engine, as an oil to facilitate a lot of trades in the decentralized finance industry. But what is BTC then? I mean, why they correlate? I think it's perception, because today, if you talk about blockchain, the first thing that comes to your mind is BTC. So BTC. So therefore, I think that it in itself, it's a psychological thing, I think, but I don't know.
I think so too. Go ahead, Rajni.
No, I was just thinking, if you compare ETH to a bank, then they might not be highly correlated, but within the same industry, they are going to be. And again, because money is flowing into the ecosystem at the same time, right? And it gets diverted between these two. So when you look at the ups, and when it's removed at the same pace. So I think if you just look like a balloon that's getting filled up and there's free money, everything inside is going up almost at the same time. So that's the way I look at it. And again, if there's two different entities, you can always, they don't have to be highly correlated, but because they're within a small ecosystem, so if you look at that, because I look at these correlations between ETH and Solana and ETH and everything else and BTC and BTC also has a 12-year history. And if you look at all of the cycles, and that's where ETH doesn't have that big of a history, but if you look at in every down market and up market, BTC follows a certain trend. And if you look at, there is a timing associated with what BTC does and what ETH does. So right now, one of the smarter people I follow is he was doing. There's also this efficient frontier, right? Everybody does the 60-40 BTC. ETH was considered one of the best ones, but in this state, he's at 95% BTC, 5% ETH, because BTC takes off first and then ETH goes later, and that just how it's played out doesn't mean it's going to do it again. But if that's your hypothesis, that's how people are playing it.
Right. Obviously, this is a loaded question. I think my own take on this whole thing is, I think obviously any market has something that carries value, right? And then currencies let you trade that value. To me, it looks like the vast majority of the market is very nascent. People don't understand the value. That opens up this correlation, right? The moment you start understanding the value of each thing, obviously that's when I'm looking at this market. The day when these things start separating is the day I conclude people really understand what that means and what this means, right? Right now, it doesn't make any sense to me, because everybody's trading everything like a piece of currency, right? Just, okay, I can take blue money and red money and flip it and make some extra bucks, right? So that's literally the sense I get when I look at all these I am new to this, and I'm only educated in this last 6 months or so, but it's very apparent. And one more data point, right? And I follow Wharton professor Kevin Warbach, who does this testimony at the Congress, and he's asking a very simple question, right? It's like, when the market in the crypto market has so much fear and things are falling apart, how is this still holding up? What's keeping it afloat, right? Why is Bitcoin, even at 16, when FTX is falling apart and Genesis is falling apart, the things are flying around, right? How is it even sustainable? Why is it not more lossy than Luna collapse? What's holding this? Is there a set of artificial things keeping the whole thing afloat until the day comes when people understand what this is all going to mean? Is that the new community who's keeping all of this afloat, right? So there is no rational behavior seen in the market. Like in a traditional market, if a contagion happens, you think it's going to hold Bitcoin at 16,000? I don't know. I can't be sure, right? If there's a bank run, would you be in the stock market at all? I don't know. Right, so it's kind of very psychological at this point, and it's all somehow traded like some kind of currency. I don't think any true value studies is there, or it's not very.
I mean, if you go by DCF, Bitcoin has no value, right? So at the end of the day, at least ETH is making money because it's being used as a transactional fees and it's making money as a platform. But Bitcoin doesn't. So to your point, I think there are believers in whales who've not cashed out just because they feel this is the technology of the future, or this has at the end of the day it's a perceived value. That's all it is, right? And then that's what's baking. To your point, I was wondering what is it keeping it afloat, because there are enough believers still holding on who are not selling. They might buy it at $10 or 2 cents, even at 16 they're good, but they feel like they must have cashed out a little bit. Now they letting the rest ride. So whatever it is, it's a good question, though.
So, right. Raghu, this is the question I have, and I'll conclude my questions in this slide. Right? The question I have is, when you look at a market and you're a trader and you have suspicion, where do you look for? Are you looking for liquidity? Are you looking? There has to be some sign somewhere. It's kind of floating around, holding its line right on the sand, and you don't know when the next thing is going to fall. Right? Is it the liquidity that?
No, you obviously look at. See, one thing is, you should know what is the market that you're trading, to some extent at least. I mean, if not entirely whatever it is, but you should know. Okay, if you don't know, but at least if you look at these simple numbers, as you were saying, like liquidity, which is basically the volumes that are going through, and also the open interest. If you're trading futures, open interest is nothing but the absolute longs, the net absolute longs or shorts at a particular future. So that's all it means. Open interest means how much of interest is still open, which is not at being closed. Because when you remember when we said that you can go long or short futures, and then when it expires, you need to liquidate. When you liquidate, you close your position. If you're long, you go short again. If you're short, you go long again, and therefore you have to close. You necessarily must close it. But that's why the open interest is important, right? So open interest, volumes, and how the spectrum. I mean, also to look at who is trading this projects. I mean, it's not like in one or few hands. It's not oligopolistic. If you're trading a market that is being traded by just a few hands, then it's definitely not a market to get into. So it's good to see. I think from that perspective, I think Bitcoin still holds value, because if you look at, it's a global asset in all sense, right? Everybody. I mean, I think the largest percentage of human beings holding on to Bitcoin is Indians at the moment. Right? If you pull down the whether it is Bitcoin or cryptocurrency. Okay. Yeah. Obviously, for obvious reasons, we are the the most populous state in the world. That also kind of fuels that frenzy. But I was saying, like for Bitcoin at least, I think a lot of these. So irrespective, the spectrum is quite varied. People who are holding on to Bitcoin, it's right from Ecuador to the treasurer of Miami or whatever, and you got the other companies, lots of firms, even JP Morgan, I believe they hold on to Bitcoin. So it's not just held by the usual mom and pop and the pensions and widowers, as they say, but also everybody, right? Institutions, small guys, and all sorts of, and therefore I think psychologically there is a barrier, there is a floor to where Bitcoin can fall. Probably, I don't know, maybe 12 grand, 10K, and then the other people sort of the people who had the FOMO and who have left out, they probably jump in at 10 grand, 12 grand probably. I don't think it's going to go to zero. I mean, personally, hopefully not. But yeah, I mean, you're right. I mean, it's all about perceived value there.
I mean, it's amazing. I think it's a trustless way of exchanging value, but still, you need to have trust in the system. And when you, on a daily basis, hourly basis, trust is being broken, how are people believing in this? This is my first thought when I hear, okay, everybody's hacking it on a daily basis. There's millions flowing out of some account every day, right? And then there is these exchanges running like shell companies, and they don't even have a balance sheet or whatever, right? And when these kind of things happen, it's a tricky question. Like, how do you?
I agree. But structurally, nothing is broken with Bitcoin, right? So, yeah, the market, there's a lot of things broken, but it's, for example, if you go to our regular market, right? Just because, let's say, I hope it never happens at Microsoft. So Microsoft goes bankrupt doesn't mean Google's going to zero, right? So that's what I'm saying is, yes, FTX did some unnecessary leverage and they were minting their own tokens and using this as currency. That needed to collapse, right? But nothing, when you look at why you got into Bitcoin in the first place, that hypothesis is not changed. So that's the reason I'm looking at it. So not me. That's why it is in the same bucket of cryptocurrencies, but it has hit its job. It's doing its job, and nothing's changed in that.
Okay.
Yeah.
I agree. I have so many questions regarding, but for sake of time, I'll.
No, you're right, Balaji. I mean, this is a lot more difficult product to trade than, let's say, any traditional asset or stock, because the stock is, Microsoft's quite limited. You do, if you're a fundamental trader, you do balance sheet analysis, P&L, or if you're doing some simple things, you can see all. But this is, it's so vast in its complexity, right? As you said, the number of moving parts, say within blockchain, it's like, if I don't know, I remember when Kazakhstan or Uzbekistan shut down, people moved to Texas. And people also moved to Iran, I believe, where inside certain religious institutions they're giving out free electricity, and so people are mining sitting inside religious places in Iran, and so you need to be really glued on, right? You need to know what's going on out there. You need to know what hash rate is happening, where things are moving. So the moving parts are too many to trade. But yeah, as I said, you can trade simple things like BTC versus ETH. That's the beauty of a market, which is a deep market like crypto, at least from Bitcoin ETH. You can take one particular niche segment of it, like as I was saying, like a pair trading, or just a futures and options trading, simple ideas, and then keep trading those, or cash and carry, as I was saying. And you see, so you can have multiple ways of thinking about, multiple perspectives you can get. You don't have to, bog yourself down with everything out there. That's what I'm saying. It's not possible.
This is an amazing discussion. So do we have more?
One last thing. I saw one recent article. Maybe it's old, but there is this concept of CDFI, and it was like, what now? Right? What's centralized, decentralized finance? And apparently, Binance spearheaded that, and it's like, that's interesting. The CDFI. But anyway, I'll leave it there. We'll discuss that at some other point. But that's a like what now question. It's like, what CDFI? Anyways, all right, moving on.
So is that the last one?
Yeah, I think we discussed all this anyway, so I think we can just skip. Okay. Yeah. Right. This is what I was saying. I mean, it's just reiterating what I earlier mentioned. Like, if you look at the specifications of Bitcoin futures in CME, so if you look at that, so the contract units are 5 Bitcoins. So if you buy one lot of Bitcoin, one lot of the BTC future, inside the one lot has 5 BTCs in them. So you can imagine how big it's really a gargantuan product, and that's probably one of the reasons they're charging like 15-20 grand or whatever for initial margins. And yeah, I think that I'm done with this. So if you can probably move on to your Balaji's interesting.
So I want to make sure, Balaji, you have availability to talk through that, or
Yeah,
do you want to?
Absolutely. I think we can spend another 10, 15 minutes. Again, I like the discussion now. Slowly, it's getting to more natural, right? Like just certain questions that are bogging your brain. You just have to bring that out.
Yeah, I mean, this is the intent, right? We are all at a dinner table or a bar, whatever you want to wish. I mean, just friends talking, and it's just a good way to learn and for audience to learn too. So this is great conversation.
Yeah.
Thank you, Raghu.
Thank you guys.
Yeah, it's gonna. All right, let's shift our focus to Web3. All right. So I just wanted to, again, I have a few slides. I just wanted to, again, we have been continuing on this track of what's Web3 or what's interesting. The last topic we saw was how EigenLayer is trying to use or repurpose the trust layer in Ethereum, so people don't have to go build their own trust layers, because what's happening in Web3 is that the distributed apps are starting to use Ethereum, and then now they need something else. They have to go to another blockchain, and that's another trust network. So now it becomes what do you call a fractured trust, right? So you have other places of trust, and now the weakest link is the one with the least amount of trust. So no matter how much you claim, it's all safe and secure. You can see, or the average user does not know this, but the dApp itself, which is interacting to many of these blockchains, is bound by this condition where it's not protected by the Ethereum trust layer. It's the weakest link is that particular API call that it used to some other blockchain, which has not so secure thing. So things like that, right? So so this time I just wanted to go at a very high level, see what is the stack? What does the Web3 stack look like? What is this Web3? Again, people are still trying to come up with a good definition of it, because it has multiple definitions in my mind. Again, we want to look at it from every angle that the industry is looking at. So this is one other perspective. So with that being said, so let's look at blockchain as a whole, right? What does blockchain do, right? So if you are to broadly divide it into major operations, so you have the execution layer, which is executing the transactions and produce new state changes. And then you have the settlement, which basically makes sure the transactions are correct and protect you from fraud, and make sure the nodes talk to each other, make sure the actual transaction settles in a proper way. Consensus, of course, is to reach the agreement in which order these transactions are going to be stored, and eventually data availability. But once this is all done, you want to make sure these transaction data are available on demand. So this is the four broad strokes. And when you look at the blockchain evolution, right? So you started with blockchains doing all of these. It's called the monolithic era, or whatever the traditional term is, right? So it's like single big block doing all of those operations. But now, fast forward, we are starting to go into more modular, because I think what happened is each of these layers is going through different innovation cycles, and people are starting to want that freedom to experiment with each layer. Maybe somebody has a different way of coming up with a consensus algorithm. Maybe somebody has a different ordering logic. Maybe so our execution, which is being done in a different way. So there's faster execution, and layer twos are taking that as a separate innovation field and trying to commit that into Ethereum main chain. So things like that are happening all the time. So eventually it's all moving into this very modular structure where innovation can happen in any of these layers, right? And that's why I think the original thought of, okay, what's core to Ethereum? What has it collected in the last decade? I think it has collected Ethereum, and they collected this trust layer, and we should find a way to share that trust layer rather than keep reinventing it, because it honestly is the actual cost of doing business for any new blockchain. Right now they have to spend all the marketing, bring more people into this trust layer, and then boot start. And we don't want to do that again and again. Just waste of time and money. So in general, this is what, again, there are a few companies listed here, not by any means the only ones, but I just pulled this from Block Research paper. So this is where current state is, right? Getting into more and more modular layers. So Web 2 and Web 3, this is the next type of, how is it different, right? So what does this 3.0 mean? What does it even mean, right? So if you look at the general Web 2.0, you have the client communicating over the internet to centralized servers. Again, the concept of centralized and decentralized it has to be understood in a proper way, right? So what it means, centralized server, is not like these servers are in a single data center in a single location, that we are far away from that with the cloud. Everything is distributed. The centralized server makes the comment here that Web 2 has centralized the power of this particular hosting or whatever. These big companies now control this, right? So that's the centralization. This talks about the centralization of the power. There's few companies who have all the power to control this. Not necessarily the actual machines and servers. They are still distributed. They are all over the place. So with Web3, now we have this new paradigm where crypto comes to the rescue. I think the key component is the wallet, and you're keeping your private key, and the public-private key encryption enables this trustless, no middleman handshake, which spurred this whole array of innovations, right? So with the Web3, I think the key component is the wallet. That's the door, right? That brings you into the Web3 world. I don't think with the Web3, without a wallet, if anything exists, because that's the key, right? That's the private key, public key pair that you're holding that lets you transact in this way. Without the wallet, it just falls back to Web 2.0 type of thing. And so the second component of it is taking stock of compute, storage, networking. We went through some combinations where how people are trying to make the internet more decentralized, like one company called Syntropy. So take all the fundamental computing, storage, and networking and make it decentralized. Okay, there are other, again, we can walk through that in a different time, how they are not. Again, people can refer back to older episodes to see why they are not decentralized at this point in time, even though that was the original promise of the internet. So this is, again, another attempt to make that all decentralized, make this transactable through this encrypted mechanism that the blockchain sets up. And more importantly, I think the Web3 is bringing this value, or retaining, or you own the value to what you're doing, right? That's the bigger add-on to this thing.
So Balaji, help me understand, like, let's just take a Web 2 tool, right? It could be Google Photos, it could be AWS. How would it look in a Web 3 world? We all know how it looks now, so I want to kind of
Right. So let's talk about, that's an interesting question, right? That's an interesting question. I think we have all, again, I spent a good couple of decades in the development software side of things. And so have you both. You have spent some amount of your life in software. So I think the way current software is built in the Web 2.0 is going to be dramatically different from the way it's going to be built in 3, for one primary reason. I think Web 3.0 comes with this concept of composability, right? So it has a compounding effect on software development, right? So you're able to sort of take these Lego pieces and start creating your own layer of value into the value chain. That is previously in the Web 2, if I were to develop something, I need to hire developers, I have to do my own stuff, and then I use some APIs that I pay for to bring some value in. Then I go to Apple Store, get permission to publish it. I go to Google Store, get published. I mean, there's this whole hierarchy of things that you have to do before you get somewhere, right? So that's the typical process of getting a software built. In the new 3.0, again, not necessarily specific to Photoshop or anything, I think how would anyone do this, right? I think that's where the key fundamental difference lies, where anybody who has a value proposition now can come in. You don't have to be an expert in trying to master this agile technology to develop software, right? So what you're doing is you have something of value that you're going to bring to the market, and you're going to look at all the primitives that are available in the Web3, which is going to be way more than the primitives on 2.0. I think you can see the beginnings in 2.0, which is the open source. Open source is kind of the core that brought all of this to life, right? So the open source primitives, even though it's like a lot of ragtag teams trying to stitch things together, leave them in the open source world either half done, or maybe some of them take off and some company buys it and does this. Fast forward now, everything is open source. Everything is being done in this blockchain where people can audit and look. Brings a lot of value. So all you need to do in the new world is probably new Web3 world is to pick these puzzle pieces and stitch it together. And that's where it becomes way more interesting, primarily because you are adding another cent to the value chain, possibly, right? And there's a trickle down effect to every layer. So it'll be obvious if you look at the stack here, right? So if you look at the Web3 stack, right, you have these, again, they have a funny way of putting it in the dApps on the vertical hierarchy here, right? Doors, applications, and primitives and protocol. It's another dApp. But it's distributed app is a dApp. So if you look at it, the base layer is the protocols, right? All these blockchains and layer X's. For me, the most interesting, innovative things are these primitives. The primitives, you can see already, so many of them come into play, right? When you compare to the existing Web 2, how many of these primitives are available for people like you and me to go assemble? Like, for example, look at, you have a store primitive, compute, analyze, communicate, social, govern, identify, secure, transmit, buy, sell, borrow, lend, stake, insure. I mean, these are all delivered to you as a package by the industry guys, right? So I think that's the real power. Now you can stitch and copy and combine these in any form or shape to create value. That's the real power.
So you have more pre-built Lego pieces to build your structure instead of having to build every single, maybe not every single, but 80-90% of your Lego pieces in the 2.0 world.
Correct. And that's what is going to make these innovation cycle faster, because now you can start combining this and see the value faster, right? Not
you can go directly into focusing on value you're providing than spending lots of cycles on the technology aspect of it.
Exactly. And more importantly, again, we have counter elements in the Web 2.0. I mean, you can say primitives are similar to SDKs you would buy from companies, but they are very limited. These I see more like functional SDKs coming into play. The domain experts are putting out these functional SDKs. This is cool.
So
right?
That is the biggest difference.
I don't need to be a financial guy. I just need to know how to use that API to get my job done.
So I think SDK, I was thinking low code or no code, but again, those are not functional. They just make the programming easier, but these are already pre-built functions you're calling into your process. Got it.
Correct. And that's what is leading to this explosion of DeFi activity. Anybody can build, as long as these primitives are there and these are verified and these are working from you. I mean, they call it a fork, they call it a this or call it a that, but the accessibility to these modules, which are dependable in some sense. Again, not perfect by any means, but it's dependable to an extent where you can start showing off value. And each application that builds on top brings more value to it. And I think the beauty of this tokenomics and the money flow is that you almost have this value chain ever expanding if that particular domain is expanding. So people in the same value chain extract value over time, incrementally. Like royalties, right? Like if you do, that's why I named it like a picks and shovel. Like if you wanna invest your time in one of these primitives, if that particular storage primitive takes off and people start storing everything in a distributed storage, Philcoin is going to benefit, Filecoin or Arweave is going to benefit. They're all going to benefit one way or another because they have to have few options to store in a distributed way, and eventually storage is a very key component to anything you develop over time, right? So they will reap the rewards. It's like the
two layers I'm looking at, right? As a builder, you can use these to build your own whatever solution you're trying to solve. But even if I wear my investor hat, then you look at which one of these is getting the most adoption and make a more educated guess about investing in that protocol, right?
And more importantly, how does it grow, right? Because storage is probably not a good example. It's just a foundational element. It's obvious that everybody needs to store something. Compute is another one. It's very obvious. Everybody's going to use compute for something or another, right? But things like verticals here, like you can see, finance is the first vertical in there. But I think many more are going to come in there as primitives. And once that happens, now you have access to a whole bunch of Lego pieces that you did not have in Web 2.0.
So, I have a question. So, where is the competitive advantage? Let's say if you take primitives, right? They've got two different primitives, which are trying to propagate exactly similar values. So, where does the competitive advantage
That's a very good question, right? So, this is one thing I struggle with when you talk about competition and a zero marginal cost product. Right. So what is the competition? Like, for example, if I were to say every one of this is zero marginal cost to scale, what does competition mean anymore? That's the counter question I would ask, right? If everything I present here is like click a button and it spins off and scales and it's almost like zero cost, there is no barrier.
Yeah, who wins?
So,
who wins?
Exactly. So I think the answer is obviously everybody wins. Let everybody extract value. It's a community. That's one answer to this whole theory, right? Let there be competition. Let there be, again, whoever wins is probably because their UI is much better looking than yours. Or some factors like that play into people's psychological thing. Because I think the world, as we see going forward, is becoming more experiential. I think we should focus on that, right? Whoever makes the more experiential, more appealing to senses of people are going to, it's not necessarily because you have the greatest finance idea. Probably your app sells because it looks much more relatable to the user.
Yeah, Starbucks doesn't sell coffee, it sells experience, right? So
it is an increasingly experiential world that we are going to move into, right? You can see the NFT craze. These are all experiential things, right? So it's not physical, it's experiential. So I think that could be one answer. Who get the advantage? People who make more experiential stuff. That's why I said, as the things that used to cost money become primitives, and it's an atomic operation that's available for free, we have to focus somewhere else to bring value. It's not going to be the same thing that we did before.
Cool. Sounds good.
That's all I got. So essentially, that's in general where the industry is, and that's another way to look at Web3. And if you're coming from a developer world, like it gives you this, maybe you can get out of the traditional way of developing and say, hey, let's go assemble these puzzle pieces, see what can I come up with. That's cool. That gives much more experiential value or other things to people, right? Or maybe there's a combination in here, because now we all know, right? A lot of these primitives, then there's so many ways you can combine. Who's going to find that combination that's going to appeal to people? Maybe that's a competitive advantage, right? Whoever finds it first. Like Ethereum. I mean, Ethereum has the most followers because it was the first and it was able to retain that. But there are many more chains. But why does Ethereum have all those fellowship? Similar questions get asked every day.
First mover advantage, maybe.
First mover, believers, all kind of stuff. That's the new type of thinking, I believe. Maybe. We'll see.
Awesome. Brilliant, guys. That's a wonderful discussion we had, conversation.
Yeah, that's pretty much what I have. Rajni,
I'm just talking to myself. I know, I was like, that was one of the best conversations we had. So I definitely learned a lot from our conversation today. So we will continue this, guys, with more AI blockchain conversations in the future. So stay tuned. Thank you all for tuning in this week. See you guys soon. Thanks, Balaji.
See you soon.
Thank you.
Bye.
Thanks, guys.
Thanks. Bye.